Are we seeing another 2007 in slow motion?
Double B's, 0. Triple B's, 0. Dog shit.
If when I logged onto the internet, everybody was very complacent and everybody was very bullish, that really would worry me.
All the risky lending has been pushed into a darker, less regulated corner, which is private credit funds.
There are lots and lots of terrible scare stories that would persuade you to, frankly, build a bunker, buy some tins of beans and a gun, and go and wait in there for the apocalypse.
I'm preparing for the second worldwide Great Depression.
If you really want to panic yourself into never investing in anything, there are lots and lots of things you can look at.
The party's over as of this morning. There's going to be considerable turmoil in the markets for the foreseeable future.
Welcome back to Noise Cancelling, the podcast where we try to separate financial reality from market drama. I'm Jon and Neil, and with me, as always, is Neil Woodford. Each week, we look past the headlines, past the noise, and talk about what actually matters for long-term investors. If you want more of Neil's thinking, you can find that at W4.0. The link will be in the description down below. Today, I want to answer one big question for long-term investors. Are we seeing another 2007 in slow motion, or is this just a noisy, fragile system that you can still sensibly invest in? Neil, on the surface, the US economy doesn't look like a system on the brink. Growth has held up, unemployment is low, equity markets are still within touching distance of their highs, and yet the language from the media, central banks and regulators has shifted back to vulnerabilities and alarm bells. How fragile does the system really look to you right now?
It depends on your perspective, I think. If you spend your time on the internet looking for scare stories about the US economy or the global financial system or global financial markets, you'll find all sorts of terrible scare stories that would persuade you to, frankly, build a bunker, buy some tins of beans and a gun, and go and wait in there for the apocalypse. I think we are in a very strange time, really, when really the internet provides a platform for so many people with extreme views to promote those views. And I think, in a way, the more extreme the views are, the bigger the audience. And so there is an incentive for people to sound alarmist about everything because they want to have an audience that drives their advertising revenue or whatever, and drives the economics of their podcast or their platform. So you have to bear all of that in mind when you listen to lots of the stuff that you hear on the commentary, really, that people promote on financial markets. So what encourages me is that when everybody's very bullish, that's the time to get quite worried, okay? Because that, almost by definition, is an excess or an extreme setting, policy setting, sentiment setting, if you like.
That goes back to that old Warren Buffett quote of being greedy when others are fearful and fearful when others are greedy.
Yeah, I think that again, Warren Buffett nailed it. At the moment, lots of people have lots of things to worry about. I mean, this morning, I've just read through a few of the sort of scare stories. So, in the last week, I suppose, the major scare stories would be about private credit, a $40 trillion market, and people like Andrew Bailey, chair of the head of the Bank of England, has jumped up and down about the private credit market. Not particularly alarmist, but he's sort of concerned about that. He's also concerned about tech valuations, as are the OECD and the IMF. I've seen stories about the Japan carry trade, about bond yields. I've seen scare stories about the impact of AI on US employment, an impending debt crisis as a result of people losing their jobs and not being able to afford their mortgages, all this sort of stuff. In a way, I'm sort of encouraged by it. If people were telling me, if when I logged onto the internet or I was reading through, the sort of latest bunch of stories, everybody was very complacent about everything, and everybody was very bullish, that really would worry me. The fact that everybody seems to be so scared and so unnerved by the structure and complexity of economies and the structure and complexity of financial markets is something that intrigues me but doesn't concern me, because it's always the case. certainly in modern financial systems.
Let's look at where the risk might lie. Regulators usually slice financial stability risk into 4 buckets: valuations, borrowing by households and businesses, leverage in the financial sector, and funding and liquidity risks. Is there one of those buckets that worries you more than the others?
Yeah, I think everywhere we all know that the pandemic was a global crisis, and all sorts of governments reacted to it in different ways. But basically, public debt went up significantly as a result of the interventions that took place at the time. Some economies took a very different approach, like Sweden. The UK took a very sort of interventionist approach, and as a result saw a very significant increase in public debt. And other authorities around the world did exactly the same thing. And so the impact on public debt, it was not alone here in the UK. It was rippled across all developed economies, and the burden of that extra debt in public finances has got to be borne going forward. Somebody's got to pay for it. We're all paying for it, and we will carry on paying for it. But interestingly, when people talk about public debt, they never look at the other side of the balance sheet, if you like. Look at what's happened to private finance, what's happened to household balance sheets. And what you see in developed economies across the world is that the value of assets owned by households and the deleveraging that's taken place in the corporate world and in the household economy is phenomenal. I've never seen anything like it. So when you look at what's actually happened across most economies in the developed world, what you see is a huge increase in public debt, but a huge reduction in private debt. You can understand why, because during that period when the governments imposed constraints on the economy such that the private sector couldn't function, the public sector had to step in and be, if you like, the consumer of last resort. And the ripple effects, I believe, the ripple effects of the financial crisis, the pandemic, and the war in Ukraine have been felt not just in those sort of energy prices and interest rates and inflation, but also in the fact that private consumption has been depressed in many economies, not all, but in many economies as a result of what happened. And the public sector has had to sort of step up and be the consumer of last resort. Now, what I think we'll see going forward is economies delivering better growth as a result of, for example, the AI industrial revolution and the huge amount of private investment that's going into enabling that industrial revolution. Business investment is picking up pretty much everywhere from what I can see. And I believe households are in a great position, particularly in Western Europe, for example, to step up levels of consumption, and particularly in the UK economy, which is sort of my hobby horse. So I'm not so fearful about high levels of public debt. And there isn't really any sign of stress in public debt markets. People have been whittering on about the unsustainability of Japan's public debt for the last 30 or 40 years. And bond yields in Japan have remained stubbornly low. Now, they've gone up a bit recently. Japan would welcome that to some extent because it's a sign of it's a sort of signal that their long fight against deflation, low growth is possibly beginning to be won. But nearly all of Japan's debt is owned domestically within Japan. Japan's debt burden and debt problem is domestically financed. They do not rely on the kindness of strangers. They rely on the high savings within the domestic economy. If those savings decline because Japanese businesses and consumers start to invest more and spend more in the economy, then of course Japan's government doesn't need to borrow so much money. So whenever you look at public debt, you're only looking at really one side of a balance sheet, and you've got to look at the whole balance sheet to get a sort of a proper perspective. And my view is that even though I am a little bit concerned about the size of public borrowing and the deficit in the US, it is significant. That is at the back of my mind. I would like that to be lower, not least because, of course, the saving in the US economy isn't as high as it is, for example, in the UK. The reason that people, I think, have been saving less is because they've accumulated so much in terms of wealth, because the market has performed so well, and US households are very exposed to the US equity market. So US financial assets and physical asset ownership has delivered a great outcome for the average US family. Anyway, so look, I don't want to be too dismissive about the constant stream of scare stories that you see every day, but my experience is that these are they're echoes of all the same stories I've been listening to for a very long period of time. Lots of people have been telling me the world is about to end. These are the sort of latter-day sandwich board guys. And I sort of every now and then I think, that's interesting, I'll have a look at that. And then you find it's a sort of, it's the usual alarmist fare that on the whole you typically dismiss.
We saw earlier in the year a couple of relatively obscure US firms blow up. Straight away, the commentary was all over it, saying, this is 2007 all over again. When you hear that kind of comparison, do you think it's a fair warning?
No, I don't. No. Businesses are blowing up all the time. Businesses are being created all the time. It's a constant cycle of sort of destruction, death, and rebirth. I think it would be completely wrong to sort of jump up and down about two highly levered businesses that went bust as symptomatic of a creaking system. I don't think that at all. Private credit, I've been sort of doing a bit of work on private credit in the last week or so, and to me, the private credit market, if anything, looks to me to be a very healthy evolution in terms of where we were in the noughties in a way, and where we were in terms of the banking sector and what led up to the great financial crisis. I think we have a much more balanced, healthy lending system in the US now than we had back then.
Well, if you're watching this on YouTube, let us know in the comments which of those four buckets you think is the real weak spot and why. Valuations, debt, leverage, or funding. Neil and I are going to go through your comments after the episode, and we look forward to seeing what you think. But let's take this to the first of those vulnerabilities and take a look at the plumbing, because that's where a lot of the current anxiety sits. And there's a fashionable line at the moment that the safest assets in the world, US Treasuries, are now sitting on top of some of the most leveraged trades, particularly in the futures and repo markets. Neil, for someone who doesn't live in the futures market, what are the hedge funds actually doing in this trade, and why does it only work as long as they can borrow huge amounts of money short term?
Look, I just don't believe the largest owners of US public debt are not hedge funds. Hedge funds are a large segment of the investment industry, but they are not they don't have the biggest balance sheets by any means.
We keep hearing about this basis trade. Very simply, the basis trade is a hedge fund trying to exploit the price difference between a US Treasury bond and the futures contract linked to the same bond. So they buy the cheap one, sell the expensive one, and then they borrow huge amounts of money to scale it up. As long as the funding is easy to get and the prices do converge, they make a small amount of money, but a steady profit. But when that funding dries up, or if prices move the wrong way, it can turn into big losses.
You can see why highly leveraged positions are seeking to exploit tiny changes in the price of a futures contract and its underlying asset. Look, these are manifestations of the way an incredibly arcane, sophisticated, complicated financial system and financial market environment. Borrowing money to buy and sell US Treasuries seems to me to be, a fairly uninteresting way to try and extract a living.
So when markets are calm, people say that these trades add liquidity. But when the market's under stress, when margins move or repo haircuts start going up, those same buyers turn into forced sellers of treasuries and actually can make liquidity worse just when it's most needed. Is there a genuine design flaw in how this part of the system is now working, do you think?
It's really hard to know. I mean, I don't know, but I don't think so. Sounds pretty moronic thing to say, but it's a bit like the worried well, I suppose. If you really want to panic yourself into never investing in anything, there are lots and lots of things you can look at and go, well, that looks really, really complicated. I don't really understand. It looks very dangerous. I think the thing to bear in mind is that financial markets are inherently complicated, arcane. Lots and lots of different institutions and embrace all sorts of different and complicated strategies. Leverage is used in financial markets, but to my mind, as long as leverage is used against assets that don't tend to move that much in price, and US Treasuries would be a great example of that, the risk related to that sort of transaction and that sort of leverage is lower. And there are all sorts of people taking different views. So we all tend to think everybody's the same way in this market, and they're not. And the liquidity created is because all sorts of people have different views and different strategies. And if everybody had the same view, there wouldn't be any point in indulging in the trade because there would be no margin in it. But my sense is that there are lots of people who oversee financial markets, who oversee these markets, and they tolerate this sort of thing because they don't see the systemic risks that a lay observer does.
Then you've got the Blackrock angle, and they've just turned underweight long-dated treasuries, partly because of the collision between US deficits and an AI capital spending boom that needs to be funded. If you're right about US inflation falling, presumably those same bonds could actually become more attractive. Who do you think's misreading this here? Is it Blackrock or the people ignoring your view?
Lots of different people have different views. I mean, a few weeks ago, I reported that Legal & General, which is the biggest investor in, the UK's biggest investor, largest asset pool under management, went bullish on UK gilts. You know, the market all the while is seeing different institutions with different views. That's what makes the market. BlackRock have decided that they want to be underweight in US Treasuries, but that might mean that they reduce their holdings by, I don't know, a relatively small single-digit percentage. They still will be very, very substantial owners of US Treasuries. People tend to associate, they're BlackRock bearish, they're going to sell all their treasuries. I don't think so. BlackRock, has made a living out of basically running closet index funds or explicit index funds. They'll have an index position in US Treasuries. It's only their active fund management decisions where they'll be underweight, but there'll be lots of other people with a different view. My view ultimately is bond yields are much more influenced by what happens to inflation and short-term interest rates, official interest rates, basically, than they are by whether BlackRock decides to be a buyer or seller. So, if you really want to know where US Treasuries are going to go, then you've really got to have a pretty confident view about US inflation and short rates. My view is that inflation in the US is going to come down from 3%, and it will certainly come down through next year as we annualize the impact of Trump's tariffs. As inflation comes down, so will Fed funds, and so my view is interest rates are headed down. We may well get a cut next week. We'll get more cuts next year. I think the labour market, the weakness in the labour market will begin to feature more prominently in the Fed's thinking, as I've been saying for a while. That is why we're going to get a cut next week. And that will be a much more influential impact. Those decisions will have a much greater impact on the 10-year Treasury than will BlackRock's decision, for example.
Well, that's one version of fragility covered in the plumbing in the Treasury market. Let's look at another one, which is the idea that we've recreated 2007, but in private credit. The story goes something like this. Post-2008 regulation forced banks to pull back, and all the risky lending has been pushed into a darker, less regulated corner, which is private credit funds, which have now grown into a multi-trillion-dollar market. The scary headline is that we've basically recreated 2007, just not inside the banks. When you hear that argument, what's your reaction?
That is another example of the guy with the sandwich board, jumping up and down with a megaphone saying the world is about to end. My view, my analysis of private credit is that this is an appropriate and positive evolution of the lending market. Part of the problem that we encountered back in 2007, 2008, when we went into the financial crisis, is that the lending was dominated by a relatively small number of giant banks with giant balance sheets. And they indulged together in some pretty lunatic behavior. And that's what got us into a very, very nasty mess that could have been far more damaging than it turned out to be. What we see in the private credit market, the evolution of private credit market, is a much more distributed system.
Well, you made the point that most outstanding private credit is actually investment grade.
Yes.
And the debt is transparent, tradable, widely held by long-term investors like pensions and insurers.
Yes.
So does that make the system safer by spreading the risk?
Yeah. Let's remember that banks are structurally, I mean, lots of people, when they sort of analyze banks, talk about the fraudulent structure of banks. Basically, banks have deposits which, they're called demand deposits mostly, not deposits. There is a maturity mismatch in every single bank. The deposits can be called more quickly than their loans. So, the system requires confidence in the banking system, and emergencies or problems are created when that maturity mismatch is undermined by falling confidence. Okay. But that is the nature of banking. What you have in private credit is financial institutions lending to, in the US, typically private and public businesses. But those institutions don't have that maturity mismatch. They have the ability to own that debt until maturity. They aren't exposed to the sorts of pressures that the banks were exposed to back in 2008 and during the great financial crisis, when depositors wanted their money back and there was a liquidity crisis. I would argue that the evolution of the private credit market, where I believe something like 95%, maybe even more, of private credit is investment grade rated, and rated by people like Moody's, independently credit rated. That evolution of the credit market is a healthy evolution. Since the financial crisis, banks have been constrained, capital constrained. They've been constrained by regulation. They have found it hard to lend long. And this has opened the door to the evolution and the creation of the private credit market. And so what you find is longer credit tends to be filled by private credit in the US, and banks are typically lending over shorter time periods. Now that actually might be healthier for banks.
There's still roughly a couple of $1 trillion worth of leveraged lending inside the market, which you said in our discussion earlier in the week that you wouldn't sanction. Is that the part that genuinely worries you, or is even that risk being overstated?
The leverage lending, which is a tiny proportion of the total, is I think much more focused on financial markets, enabling liquidity, leverage lending into hedge funds, for example. Leveraged exposure is something that some investors are happy to embrace. Not me. I'm too cautious, but I don't see it as some sort of systemic risk for the financial system.
So this classic 2007 comparison that post-crisis regulation just pushed the same risk into different wrappers, and that the next crisis will start in private credit instead of subprime, just noise as far as you're concerned?
No, I just don't see the parallels. I don't see the same thing at all. The vast majority of the 40 trillion private credit market is conventional lending over relatively long periods to US businesses, public and private. I mean, it's not the sort of nonsense that was going on in the lead up to the financial crisis.
Okay, quick pause. If you're still watching at this point, you're exactly the kind of person we had in mind when we created noise cancelling. But around 70% of the people who watch these episodes aren't actually subscribed to the channel. If you want more of Neil's take on markets and the economy, and to know when new episodes drop, hit subscribe and tap the notification bell. It doesn't cost you anything, but it tells YouTube to show these episodes to more people who actually care about investing and not just about the latest meme stock. Right, back to the story. Neil, we've talked about fragility inside the US system. Let's bring in the quiet character in the background of all of this, which is Japan. Most people still think of Japan as the home of zero rates and very dull government bonds, but Japanese investors hold huge amounts of foreign debt, and the yen has been the funding currency of choice for carry trades for decades. Why does a relatively small move in Japanese government bond yields suddenly matter so much for US rates and global markets?
I don't think it does.
I worked so hard on that question. Why doesn't it matter?
Japan has been trying to break free from its deflationary, low growth, post crisis challenge for decades. Japan's central bank and its government has really been focused on generating, weirdly, doing the things that the rest of the world isn't doing, which is to try and generate inflation, trying to, through that process, create higher rates, higher bond yields. In some respects, the fact that Japanese government bond yields have gone up is a sort of sign that is finally becoming slightly more successful. It's been a long while. The vast majority of Japanese government debt is owned in Japan. I think the Japanese central bank owns 70% of the Japanese government bond market. So it's a domestically financed government debt problem or issue. And of course, is the corollary of that is that savings in Japan are massive. So Japan really finances itself. It doesn't really rely, once again, on the kindness of strangers.
When markets start to price tighter Bank of Japan policy, as I understand it, there are basically two things going on. Japanese insurers and pensions rethinking their foreign bond ownings, and leverage players worrying about the yen carry trade that they've been running. Do you think either of those is a source of fragility?
Not really. I mean, if you looked at the Japan carry trade and say, well, yeah, of course, people have been borrowing Japanese yen and investing in dollars and pocketing the difference. But of course, in the meantime, what they've been nailed by is dollar weakness against the yen. It would have been a disastrous strategy. So if there is a yen carry trade, it's something that happens over very short term time periods and is part of this sort of very arcane, complicated, unbelievably intricate, just impossible to understand financial system that the world operates in now. I'm not sure that this idea that there is some sort of structural problem in the yen carry trade means that because bond yields have gone up in the US, some impending crisis is about to unfold. I think it's another sort of the end of the world is nigh sandwich board person jumping up and down with a megaphone. I just think it's not correct.
Okay, well, another place people have been looking for signs of systemic risk is in crypto. We touched on it briefly a couple of weeks ago, but especially with the MicroStrategy story and the growth of stablecoins, let's take a closer look. So I sent you a note earlier in the week about MicroStrategy, the biggest corporate holder of Bitcoin. It's now trading below the value of its own Bitcoin and has a large pile of debt layered on top. You've described Bitcoin as a shit investment idea, but you've also said that you don't see crypto falling in value everywhere as a systemic risk. What is the difference for you between a horrible investment and something that can genuinely destabilize the financial system?
The outstanding investment in crypto is pretty big. I saw a figure as high as 30 trillion the other day. Is crypto about to go to zero? No, I don't think it is. People have told me, what you don't understand about crypto is it's a hedge against fiat currency devaluation, the printing press. And you might argue, well, yeah, it is, but there are much better ways to mitigate for the printing press, and that's by investing in real assets that give you a return on the journey. So I don't really subscribe to that particular view. I'm not surprised that the MicroStrategy is trades at a discount to the value of its Bitcoin. If it had to unwind its Bitcoin, it would probably drive down the price of Bitcoin. It's a bit like the old adage, investment trusts typically trade to a discount to the asset value of their holdings, typically because there are sort of concerns that liquidating a portfolio doesn't turn out to be doesn't deliver the sort of net asset value, and I think the same rule probably applies to Bitcoin. So that doesn't surprise me. What perhaps may have surprised me is that it ever traded at a premium. But then again, Bitcoin sort of lurches between sort of huge bouts of enthusiasm and huge bouts of depression. So look, I don't see anything remarkable in that statistic.
Well, a more serious, perhaps, policy debate seems to be around stablecoins, which is potentially a multi-trillion-dollar market now. And they're used as a sort of shadow dollar system, but without deposit insurance or a classic lender of last resort. There's a nightmare story that a digital bank run that ends up on the taxpayer's desk. Is that a realistic risk to the US system, do you think, or are we still overhyping crypto's ability to infect traditional finance?
I think we're overhyping the ability of crypto to infect the whole financial system. My understanding is that stablecoins are about $300 billion in total at the moment. That just isn't big enough to destabilize the global financial system or even the dollar system. Even if you assume that it all goes horribly wrong. And my understanding, well, the slightly more stable sort of characteristic, of course, of stablecoin is it is backed with fiat currency and other assets. So the net position of stablecoin, the net, i.e. not backed by other financial assets, would be even smaller than the 300 billion. I think you've got to go some way to sort of imagine. You've got to be a pretty sort of instinctively nervous investor to think that something goes wrong with stablecoins that then triggers something that undermines the net position of stablecoins to such an extent that it sort of has a ripple effect through the financial system. I just can't see how that is big enough or significant enough or likely enough to be something that you should worry about. All of these stories are can be quite leery. There's plenty of very, very exaggerated commentary about these sorts of things on the internet. Lots of bloggers, lots of podcasters are forecasting the end of the world regularly on a daily basis, and yet the world sort of keeps ticking along. What's interesting, I think, what might be a way to sort of audit this nonsense is to sort of look back. I don't know. Let's go back last year and let's count up the number of people who said the world was about to collapse and the financial system was broken, and just ask all of those people, well, why didn't the world come to an end? Why didn't the financial industry collapse? What is the thing that you got wrong? I'm sure many of them wouldn't really know. They just carry on with a new story, a new reason to be bearish. And I don't think it's really because they are that bearish. I'm pretty sure many of the commentators who say the world is about to melt down have got lots of equities or stablecoin or Bitcoin or whatever it is in their own portfolios. I just think they're trying to drive a business and try to get an audience. I know that might be a bit of a cynical thing, but I just think a lot of it's a lot of old nonsense, to be honest.
Well, we've walked through the scary version of the story. Leverage trades in treasuries, private credit supposedly being 2007 in disguise, Japan as the hinge for global funding, and crypto blowups. Let's reframe it. If somebody wanted a simple way to track whether this fragility is getting better or worse, what would you put on a fragility dashboard?
I think for me, the things that keep me up at night are real economic things. Does China eventually do something silly with Taiwan, for example? Does the war in Ukraine ripple out? Does somebody somewhere do something that they didn't intend to do that results in some sort of escalation? It's those real economic, geopolitical things that concern me, really. We've been through a number of stories this morning, and to some extent, I have to put my hand up and say, look, I just don't know enough to comment in deep detail about each particular scare story. But all you have to do is scratch at the surface of most of these things and find out that they're very, very, very flaky sort of journalistic propositions that I think have very little credibility. As I've said, and I said this a year ago, and I'll say it again now. I mean, for me, the global financial market environment looks to me to be relatively stable. The things that would worry me, the things that have worried me in the past, some sort of global commodity price inflation, for example, some sort of energy price crisis. We saw how that could destabilize financial markets and economies following Russia's invasion of Ukraine 4 years ago, nearly. Those are the things that would worry me and that I want to have on my sort of fragility index. If you look at financial markets themselves, I do not see, as I've said on umpteen occasions, I do not see the sort of excesses that in the past have really worried me. The sort of excesses I saw in 98, 99, the sort of excesses I saw in the lead up to the financial crisis, those sorts of issues I don't really see re-emerging. Of course, there's turbulence. Bitcoin itself is something that clearly has the potential to destabilize its investors, its adherents. But I don't think significant falls in Bitcoin, like the one we've seen in recent months, is enough to jolt the overall financial system, which is a very big beast and a pretty resilient beast, to my mind. I actually think that the things that would worry me, the macroeconomic things that can affect financial markets, inflation in particular, higher interest rates, higher discount rates, lower valuations effectively, those things I see going into reverse. What I see globally is a shift to lower interest rates, lower bond yields, and that is generally supportive for financial asset prices. The environment actually I see as improving, not deteriorating, and becoming less risky.
Where do you actually see the best risk reward for a long-term investor?
Well, I must sound like a broken record, but I see the best risk-reward relationship in undervalued equities. They exist across financial markets, across developed economy financial markets, but the one market that looks to me to be so anomalously out of tune with the rest is the UK equity market. But I think there are other interesting financial assets that look undervalued to me, and I would include 10-year government bonds in the UK, for example, right now. And I've talked about sectoral opportunities across developed economy markets, and I continue to believe in those too. So the challenge for investors these days, I think, is rooting out the best risk return opportunities. Always, you've got to work hard to find out where they are and to do your research. That's always the case. But they might be a little harder to find now because the dominant equity market globally, which is, of course, the US market, is one that is, in my view, overvalued in essence. So to find opportunities in that market, you've got to go rummaging around in the lost property basket, really.
So to bring it full circle, the US system is fragile in places, but it's a lot less like 2007 in private credit than the headlines would suggest. And Neil, if you're right about US inflation, long-dated bonds and selected equities could still offer attractive long-term opportunities.
Yes.
In other words, this isn't everything is fine, and it also isn't everything's going to zero. It's a noisy system, and you can still find places to invest as long as you understand the real pressure points.
Yes, I completely agree with that summary, John.
Well, before we wrap up, Neil, I did promise that you could have 5 minutes on home turf and the UK budget. We've spent a lot of time on it over the last few weeks, but there's been a fresh round of commentary since the measures were announced last week by Rachel Reeves, including some very popular videos that suggested that higher earners and the ultra-rich have got off lightly. So let's just deal with that briefly without getting into the personalities involved. There's a very strong story doing the rounds that says tax changes for workers are cosmetic, while the real winners from the budget are the rich and the ultra-rich. Do you buy that basic claim, or is the reality much more complicated than the headline suggests?
That's just horse manure. That is such a ridiculous summary. The UK tax system now is objectively the difference between the tax on average earnings in the UK and the tax on higher earners is the greatest of any developed economy globally. We have a fairer tax system in the UK now than any other developed economy in the world. Wealth is taxed as well at all sorts of points on the journey, but the ability, most wealth is created through income. The way you create, I think, a sort of socialist utopia is sort of if you pursue what's going on in the UK.
This chart from the FT shows the average UK worker is taxed less than in most countries, but in no other country is there such a steep climb in the tax burden from the middle to the top earners.
Yeah, I think this is the data that demonstrates the point I've just made. We've also created a system in the UK. I think we must be concerned about this. We have a very large and growing population of economically inactive people in the UK. Ultimately, that's not good for the economy. But part of the reason I believe that we have this large and growing population of economically inactive adults in the UK is because we've made it too easy for people to choose not to work, particularly those with relatively large families. So there was some analysis done post-budget which showed that for a family with 3 kids claiming a range of available benefits, and because those benefits have been increased significantly as a result of some of the measures in the budget, but have been increasing generally in recent years, means that somebody who chooses not to work but claim a range of different benefits basically accrues an income that is substantially larger than a household where you've got both parents working, one in part-time, one full-time on average earnings. And that's the challenge you create for an economy. If the incentives are the wrong way around, people will elect not to work. Particularly if they see their neighbor making more money than they are by not working. So I think we have a problem. But nevertheless, the original question was, richer people got off lightly, poorer people got harmed or whatever. But it's just total and utter nonsense, and it flies in the face of the facts, which of course most people on the internet are pretty happy to do. The market for facts is pretty small, vanishingly small. Most people have opinions that are never backed up with facts. The facts, as are shown in that chart, demonstrate that that we have a very egalitarian tax system in the UK, the most of any developed economy globally by some measures.
So even in this story, the picture is much more nuanced than the rich got away with it.
Look, some people will not be satisfied. Zach Polanski, for example, the leader of the Green Party, which is basically a radical sort of socialist party. He's the sort of person who believes that everybody who's been successful and created wealth and has wealth is some sort of public enemy, and their assets and their wealth should be appropriated from them. People like that will never be satisfied by a budget that delivers what Rachel Reeves did. They'll never be satisfied. They are possessed with the politics of envy, and nothing will ever cure that. They talk absolute crap. What they advocate has never worked anywhere in the world in history. They promote a destructive, damaging, and impoverishing agenda, but they still believe in it because they're possessed with this sort of religious belief in the politics of envy, and nothing will cure them of that illness, I'm afraid. But I think they should be completely discounted, ignored. They're not serious politicians, in my view. They're not advocating a serious economic sort of solution to the challenges an economy like the UK confronts. They're mad, frankly, and should be ignored. But nevertheless, we have to be careful in the UK about creating too many of the wrong incentives, because we will end up with a dependent workforce that is unfinanceable for those in work.
Well, on that note, let's leave it there for this week. If you've got this far, thank you so much for watching. Let us know in the comments what you would put on your own fragility dashboard. Neil and I will go through all of those comments, and they often shape what we talk about in future episodes. If you haven't already, please do hit like and subscribe and turn on notifications. It makes a real difference to how many people actually get shown these episodes. Neil, thank you as always. And thanks to you for watching Noise Cancelling. Until next week, take care.